What up, kings and queens all over the nation? If you're a part of the royalty movement, and you already know it's all love. If you're not, and somehow you're watching this video, you might want to strongly consider being a part of the royalty movement, which is an economic empowerment movement who's serious about helping people increase their cash flow, their credit score, and ultimately build wealth. Because if we're not focused on building wealth as a collective, then we miss out on the opportunity that exists right now. I'm so happy to see so many different people who are on the mission and on the journey to better themselves financially, no matter how big or small. In the royalty movement, we're doing our part and playing our part to educate and empower as many people as possible, because we know that one person at a time is how you break the generational curse and create generational wealth. So welcome to the royalty movement if you're new to the royalty movement, and we look forward to welcoming you if you're not already a part of the royalty movement. And then shout out to everybody who's an OG of the royalty movement, been sitting on the throne and doing their thing. Now, I will say this just as a brief announcement. We recently had a Super Saturday, and if you missed that Super Saturday that my econ put on, then you did yourself a disservice. It's loaded with great value. If you don't have the link, we posted it inside the group. If you want access to it and you don't know how to access it, comment below and then we'll find it and give it to you. But you can go to the My Econ YouTube channel and watch the most recent Super Saturday. Powerful beyond belief as it relates to the testimonies, for one, and then for two, just understanding the opportunity that you have, because a lot of times you sleep on this because you don't really get my econ inside of you. You may have an active account, but until it gets inside of you, then you sleep on the opportunity that you have, not knowing that people are looking for you. People are looking for what it is that you possess as an individual, and the fact that you have a system that can help them accomplish their credit goals, their investing goals, their debt elimination goals, their income goals, because a lot of people are making a lot of money in my econ. You're doing yourself and them a disservice. So the Super Saturday usually always gets me fired up, but I'm sure you'll be able to connect and relate to something that was said on that Super Saturday that'll let you know the $1 million platform that you actually got access to. Now, let's go ahead and dive into training, because I do not want this to be too lengthy due to the fact that, I understand that people have a short attention span, but I want you to take notes. Don't confuse me not wanting it to be too lengthy with this not being a valuable thing for you to understand. And I've been in my for 7 years, and there's some terminology in here that I gained a recent understanding of, and it was like a light bulb moment for me, and it made me great returns on my investment. So I'm like, you know what, I think this is something that people can benefit from, and if you like this type of content and you want more of it, or if you want us to dive in deeper on some of these concepts at a later date, let us know. Say, hey, I want to learn more about this angle because that made sense to me, whatever the case may be. But hopefully you take notes, get some screenshots, whatever you got to do in order to maximize the time that we're spending here, and then implement based on what it is that you learn. So the title of tonight's training is Investment Terminology That Can Make You a Lot of Money and Ultimately Wealthy. Now, the slides are not all pretty and polished and things of that nature, but I promise you, it should be something in here that does what the title says it's going to do, which is make you some money and ultimately make you wealthy, because we want you to be thinking long term in terms of making money. Every dollar you earn should be having the future in mind in some way, shape, form, fashion. Yeah, you're going to pay for the current. Yeah, you might pay for the past if you have some debt. But we want you putting something towards the future. So your money should cover all tenses. We're teaching our kids now about the different tenses. They already got it, but, certain times they get caught up with past, present, and future. Your money is supposed to exist on all three tenses. It's supposed to pay for the past if you're in debt. Now, if you're not in debt, then that's a thing of the past. Then you don't have to worry about that. But it should cover the present, and if that's basically covering the basic necessities. And then you'll get to the point where your present was taken care of by some past work that you did, and now you're focused on is your future. But in the meantime, in between time, you should let your money cross over multiple tenses. The past, present and future, or the present and the future, or just the future once you get to that level. So without further ado, what I'm going to do, just for the sake of maximizing this screen, I'm going to turn off my video, and hopefully it doesn't block off anything you're able to see. Get your pen and pad handy, screenshots ready, and tune in. So let me stop this video, and hopefully if I minimize this, that minimizes on your end. Set it in present mode. Alright, now hopefully you can see this without a problem. Investment terminology that can make you a lot of money and ultimately wealthy. And I won't spend too much time on it. I just want to spend just enough time to get the point across so you can get it. And then hopefully you're already doing some of these things, and I may be preaching to the choir in certain areas. But if you're not doing certain things and it gives you a new perspective on those things, then consider implementing. So first thing I'm going to talk about is index funds, because as it relates to investing, I know a lot of people in royalty, or some people in royalty, aren't yet investing. And sometimes it can be terrifying. Sometimes it could be, you know, seeming like a steep mountain to climb, so you never get started due to the fact that you think it's so complex. Well, what index funds were created to do was allow you to invest in the whole market for the most part and minimize the losses that you can take. So minimize your risk, for lack of better words. And you want to get an index fund that has a low cost. So what is an index fund? Funds designed to accurately track a benchmark index, and I'll dive into that later. I'm going to just read them all, then unpack it and make it simple. Benchmark index, a measure of a certain section of the stock market. Examples include the S&P 500, as well as the Morgan Stanley Biotech Index. When you buy an index fund, you are basically buying all of the stocks in that index. So what a person can do is put together a certain index fund that's centered around a particular sector, and when you buy into that sector, you're not trying to see or invest deeply into one stock. You're buying a whole bucket of stocks. And when you're thinking about something like the S&P 500, the S&P 500 takes the top performing 500 stocks in the market, puts it into a bucket, and now you're able to invest into that index fund, which minimizes your risk and positions you to have some great returns, because the index funds have been yielding a great return, or a decent enough return, to at least have your money growing and outpacing inflation for the past 100 years. So that being said, it's a safe spot to put your money to at least get in the game. You'll be invested in the whole market versus trying to see if you can invest in one stock that's going to pop, because that may not be the case if you don't know what you're doing, or you don't do your due diligence as it relates to researching those stocks, or if you're not incorporating some of the terminology that I'm about to share in this video. So index funds are great for that, because it allows you to buy all the eggs that's in the basket, as opposed to putting your eggs in one basket. That would be investing in one stock. That's an example of that. But instead, you can buy multiple baskets and multiple eggs and put your money into it, and now you're investing in the index fund. So the S&P 500 is something you want to consider. One of the stock symbols for S&P 500 is SPY. That's one. And there's a couple other out there. I'm going to just throw that one out there just to make it plain, keep it simple, that you may want to consider investing in, using whatever brokerage account that you may have. And if you don't have one, then let me know below, hey, how do I go about getting my brokerage account started? And I'll point you in the right direction so you can get your brokerage account started. And do not be intimidated, because it's now been set up to where you can invest with very little. You can buy one share of a stock. You can buy partial shares of a stock and still allow your money to grow at the same percentage, even if you don't own a full share of the company. So that's a powerful concept. Sometimes people think just because they may not own multiple shares, or they only own a piece of a share, that their money won't grow. No, if the stock or the investment or the index fund in this case goes up by 50%, so did your money. Even if it was just a partial share that went up by 50%. So a person who had more stock, of course, they made more money, but the interest rate grew the same. So just something to keep in mind as it relates to index fund. The next one is ETFs, and they're similar to index fund in the case that it's multiple stocks within that fund, but the ETF stands for Exchange Traded Fund. But there's a couple of perks, and I really like the ETFs because of some of the things that I'm about to read off. But it's multiple stocks within one fund that you can buy into and have your money growing. And you can invest in certain sectors. If you can think about it, it's an ETF for it. If you just want to invest in 5G, you can invest in it. It's an ETF for it. If you just want to invest in airplanes, jets, it's an ETF for that. You know, if you just want to invest in hotels, it's a APLE, Apple Realty, that's centered around concierge services and hotels and things of that nature. It's a REIT. It's more of a REIT, but you know, it's kind of in the same family. I'll just say that. But it's an ETF for just about everything: technology, fuel, electric vehicles. I mean, the list goes on and on and on. But it allows you to put your money in a place that doesn't put you at risk, because instead of you trying to figure out one stock that's going to be the best one to pop, that may not be the case, but you can put it into a bucket and allow it to grow with everything else. So if you see a sector that's on the rise, an ETF might be a good time. It might be good to consider an ETF in that sector. Just as an example, 5G. I bought into some 5G ETFs because I know it's on the horizon, and now it's still a decent time to do it because it hasn't fully been rolled out. Same with electric vehicles. They're on the rise, so now will be a decent time to consider those because it hasn't fully rolled out. Robotics is another one. So just kind of think about some things that you can invest in that may have not already popped, but you can get in while it's a low cost, and that helps you grow your money even more. Now, let's go along the list of benefits as it relates to the ETFs. Easily accessible, so they're tradable on the exchange. Even a person who does day trade and things of that nature, they can day trade ETFs if that's something you're interested in. That's not what this training is about, but it's something that you can consider. Cost effective, they're low management fee, no front load exit charges, so it keeps you from paying those fees. A lot of times people they're not aware of the fees, and sometimes they neglect or think as though the fees don't matter, but in all actuality, those fees will cut into your rate of return, so they very well do matter. Instant diversification, so like I said, you're investing in multiple things, so the fund structure, the collective investment is basically set up so that you're instantly diversified. Transparent. Underlying and portfolio details are published daily. So it's transparent. They, can't hide anything from you because it has to be exposed fully. Convenient. Immediate exposure to Malaysian stocks in single transaction. And that's just an example, but it's convenient due to the fact that it helps you get in at the push of a button. So it's very convenient. Secure. Regulated and governed under listing requirements. So certain requirements that they have to abide by that keeps those investments secured, so you're protected. It's as safe as you putting your money in the bank, if you ask me. Liquid. Availability of market maker. And I have something blocking the area, but basically it's liquid, meaning you can access it, you can sell off if you need to, or if you want to sell off and invest in something else, or if your money grew and you want to take profits, then you can't do that because it's liquid. You can basically treat it as if you would money that's in the bank account. You transfer it to your account. It may take whatever amount of days that it'll transfer, but it's liquid and it gives you that capability. But it's another option for a person who's new to investing or just trying to get their feet wet with investing, but they don't want to risk it all in one basket. Next up on the list is the benefits of long-term investing. See, when I talk about index fund and ETFs, I'm thinking from a standpoint of long-term investing, not day trade, nothing against day trade because there's a lot of money being made in it, and I'm learning it myself. But long-term investment is one of the things that's going to help you make the bulk of your money because of all of the things that I'm about to list. Now, long-term investing is investing for the long term, so it's kind of self-explanatory. But a long-term investment could be a year or more. It could be 6 months in some people's mind. But the reason why I say a year or more is because things are subject to change. So just because something has potential today doesn't mean it'll have potential 3 years from now. So you may want to revisit your portfolio to make sure it's worth keeping in your long-term investments. So that being said, understanding the power of long-term investments does the following thing. It reduces stress levels. Why? Because if a person isn't thinking long-term and the stock happens to go down, they're automatically thinking they're at a loss. So if you're thinking long-term, you don't have to worry about that due to the fact that you're in it for the long haul to ride it out. All right, next up is present. You're present in both highs and lows. And I'll show you the benefits of being present when the market goes up as well as goes down if you're a long-term investor. It takes the emotion out of the equation. If you're not worried about it, you know you got your good stock or ETF or index fund that you know you plan on being in due to the research you've done prior to, then it takes the emotion out of it because you know you're in it for the long haul. saves money on commissions, and that kind of ties into the ETFs and the fees and things of that nature, because if you're investing long term, one thing you want to do is minimize the fees, but another thing you want to do is not always be pulling money out of it, because you end up getting charged with certain commissions. But if you're keeping your money in, then there's no commissions to be paid out. Compounding. You see, compound interest works in a way that when you invest, the interest rate that you get will allow your money to double over time. So time is what allows compounding interest to even matter. But if you're not investing long term, then there's no such thing as compound interest. Also, it's a drop in investment risk. And some of these kind of correlate. Like that ties into the emotion and reduces stress level. So the investment risk is lower. And it's lower capital gain tax. So some of these investments that you make, if you're pulling it out on a regular basis, then you got to be aware of the capital gains tax. If you don't understand how that works, you may end up overpaying in the capital gains tax, and it ate away at your profits. And that may be dangerous in terms of thinking about retirement. Last but not least, dividends contribute to boost returns on investment. So if it's a stock or an investment that pays out a dividend, if you're investing long term, what that does is when they pay out dividends, whether it's monthly, whether it's quarterly, whether it's biannual, or whether it's annually, when they pay out their returns, the dividend can be reinvested, which boosts up the return on your investment because it can be reinvested back into the stock. Or you could take the dividends if you grow it to that place. But all of those options exist if you're thinking from a long-term standpoint. It has a ton of benefits to being a long-term investor. Now, I want to transition into dollar cost averaging. And don't let this scare you if this looks unfamiliar, but some of you may be familiar with this lingo. But basically, dollar cost averaging is you investing something monthly. You want to get in the habit of investing monthly. I don't care what it is. I don't care if it's $25, $50, $100, $1,000, and that's what we'll use in this example. See, it's different when you make a lump sum investment. You see, this lump sum investment is $8,000, and now that $8,000, it goes up. Okay, boom. Then it goes down. Okay, it goes up, and it goes down, goes up, down, up again, and there's really no return on the investment for a lump sum investor. So if you look right here, it says the 0%, the return on the lump sum investment is 0% because it was a lump sum. And the market goes up and down every day, or 85% of the time, every day the market is going to go above and below the main line. So over time, you can not get that big of an investment or return on your investment if you just did a lump sum and just set back. Now, if the market climbs, of course, a lump sum can grow because the market tends to rise over time. So this is not to get it confused. However, if you look at it from a dollar cost averaging standpoint and you're investing monthly, month 1, month 2, 3, 4, 5, 6, 7, 8, same $8,000. But the fact that you invest in monthly, the first time you might have got the stock at $10. Then the next one you have to pay a little more, so you didn't your $1,000 didn't buy as much. See, right here you'll buy 100 shares. This right here, if it costs 14, you're gonna buy less than 100 shares, but at least you still bought some. But when it dropped down to 9, you bought even more than what you bought when it was $10. Then it goes up to 13.5, and you bought some more. Not as much as the $9, but you're still in there. Then it dropped to 8, and ooh, you're buying even more. 8.5, still buying more than what you started with. And then it drops again, 7.5, you're buying even more because every month you're putting some in it. Then it goes back to $10, and by this time, it's back at $10, you made a 4% return on your investment. May not seem like a lot, but that'll outpace inflation in most cases. So dollar cost averaging allows you to buy on a monthly basis, and you benefit from the rise and falls of the market, especially the falls of the market, by investing a certain amount consistently. So find you an amount that you can invest consistently in those index funds, ETFs, or whatever you feel passionate or comfortable about, and take your emotion out. So I said passionate, but whatever you've done your due diligence and research on, and you feel like investing in it, by all means, consider contributing to your investments monthly, as often as possible. If you get paid daily, do it weekly. If you get paid weekly, invest weekly, but invest regularly. But monthly is just an example, because you can invest daily. You can invest weekly if you want to. And this allows you to average out and get your average price at a place that you're more so in profit mode, or you're getting a return on your investment. So this is dollar cost averaging. Basically, for every dollar you're spending, based on the price of the market at that time or the investment at that time, you either buy less of that item or more of it. So this lets you know that if it drops, that's not a bad thing. It's a good thing if you're continuing to invest. And that transitions into the next slide. And this next style of investing is one I've grown to love even more. I like dollar cost averaging when we was doing certain investments on a monthly and strictly in one particular fund. It was a mutual fund. We dollar cost average, but I'm starting to love the next one. Now, the next form of investing, and get your screenshot, take your notes, but the next form of investing is known as averaging down. Now, it's not all pretty, so it might look a little funny, but as you know, the market can go up and down, up and down. If you buy a particular stock at $100, say this is $100 right here. If you can see this arrow, say the $100 is up, you know, at one of the top spots. Then it drops to 90. Well, your average cost right now is $100. So if it dropped, so did your money. So say you bought one share. So now that one share you bought at $100 is worth $100, but it dropped to 90. Your $100 just lost 10%, and now your stock is only worth 90. Many people get upset. They get sad. They sell, like, no, I don't want to lose any more money. But a real investor says, you know what? Let me average down. Because I was initially at an average cost of $100 because I bought one. But now that it's $90, if I buy one more, that makes it to where I spent $100 initially, $90 at this price point. So I spent total $190. So if I have two shares of this company at $190, if you divide 190 by 2, you get 95. So your average cost went from $100 to an average cost of 95. That's even better, because if it ever goes to 100, you're going to be even more in profit mode. But in this example, it went up slightly, then boom, dropped again. So every time you see a green arrow here, that's another buying opportunity, another opportunity to buy. And when you buy more, you average down. So now say that was $80. So now you bought at 100, you bought at 80, bought at 90, bought at 80. And let's say this next green one is 70, 60. But this has to be a stock that you believe in and you believe has longevity. Because if you're averaging down, the average cost that you're in it at can position you, especially if you buy more. Like, you should buy a bulk of them when they're at a lower point, if it's something you believe in. And I'll tell you why. You want to buy a bulk of them when it's at its lowest point, because now once it starts to go up, it's the least likely chance that it'll fall all the way to the bottom of whatever it was. And now when you look up, even if it drops, you're still going to be in the green, because your average cost winded up getting so low that even at its newest low point, it's still not as low as what you bought it at. I hope that makes sense. This may be a concept that we may have to revisit, but if that makes sense, let me know in the comments. If this is something you want me to dive into deeper, let me know that as well. But averaging down is something I'm starting to favor, because I'm like, oh, this can position you to never lose money if it's a company that you know is going to be around for a while. Because if you average down in it, every time you look at it, it's going to be in the green. Even if it went up and you earned 100%, but then it went down and now it's looking like a 70% rate of return opposed to the 100, you're still in the green because you bought lower than what it's sitting at. And I got quite a few shares of companies like that, to where I bought so low. Even when we had some drops over the past week, I was still in the green. And when it goes up, I'm going to be even more in the green, because I didn't get rid of it and I averaged down on some, prior to now. So just something to keep in mind. Averaging down is a key way to build your wealth and get the most bang for your buck. I like this one a little bit more than dollar cost averaging, because you're not trying to buy at a high. You waiting on it to drop. You celebrate when it drops, because now you can get more of it. And you're looking at it on a regular basis. I will say that with dollar cost averaging, it's usually you're blind investing. You're just letting it hit the account. You're not looking at it. But with averaging down, you're paying attention. this stock is on sale today. Let me go ahead and put 100 in and get some more shares, because you're looking at it different. So that's what I want you to do. Think like more of an investor, and don't get panicky. Don't get nervous when the stock goes down. Learn to average down, and we'll go into that a little bit more. However, you do want to be careful, and this is why I kept reiterating. Make sure it's something you know has longevity, because you want to avoid a falling knife. If you've been tuned in to stocks, you probably heard about the GameStop situation. A lot of people made a lot of money. A lot of people lost a lot of money. But a lot of people knew, or everybody knew, that GameStop was a stock that was going out of the window, kind of like Blockbuster did. They knew it was on its way out. So some people, when it went all the way up, after everybody had made a certain amount of money, when it started dropping, people were buying it, and they were buying it, they were buying it, thinking they were averaging down, but really they were chasing a falling knife, a company that really didn't have true value. It's just that some of the, the media and different sources made it look more valuable than what it was to make people interested in buying it. So now when it started dropping, you come in with your money like, ooh, GameStop don't go back up. I know it is. Now you're catching a falling knife, thinking you're averaging down and buying it at a discount, but GameStop stock wasn't worth anything. Just something to keep in mind. The same thing or similar thing happened with Hertz, the car rental. It was a trash stock over just looking at the duration of things that have been happening over the years. People were buying into it when it was worth nothing. So don't catch a falling knife, because you'll cut yourself. That's the concept. But basically it says, as the phrase suggests, buying into a market with a lot of downward momentum can be quite dangerous. If timed perfectly, a buy at the bottom of a long downtrend can be rewarding, both financially and emotionally, but the risks run extremely high. This term implies that the investment will never be a good one again. This is one, like I said, you want to make sure it's one you believe in, because if it's something like GameStop that doesn't have any longevity to it, if they don't figure out how to pivot and become more futuristic, then they're out of the window, just like Blockbuster. Blockbuster had the opportunity to buy Netflix, but they were like, nobody's going to want to do that, and look at Blockbuster, out of there, never to be seen again. They're just a thing of the past. So if you know it's a company that has some longevity, now it avoids you from getting caught catching a falling knife. Examples of stocks that have plummeted are plentiful. A widely held stock can drop perceptually as the equity ownership is reduced to nothing. And that's what you don't want to do. You don't want to be buying, because if you're buying, somebody else is selling it, and they're happy to sell to somebody who's trying to catch a falling knife, because they don't want it, and they don't want it to fall to zero in their hands, so they can't wait to get it off. But make sure you know it's a company that you believe in. Otherwise, averaging down can turn into a falling knife. Know the difference between the two, and it'll make you a lot of money. All right. Now, what's a stock market correction? A stock market correction often creates the opportunity to average down. It creates the opportunity to do dollar cost averaging, because sometimes stocks and companies are overinflated, meaning that they're trading at, or the stock price is worth more than it should be worth. So when the market corrects itself and people sell off on stocks and different things happen, the stock price falls. Now, you might have been investing in it and you're like, oh, my stocks are down. It's killing me. I'm in the red. Well, that stock market correction just created an opportunity for you to average down. So don't look at the market going down as a bad thing. That's an opportunity for you to get a sell. It's crazy. With stocks, if they go down, people think it's a bad thing. But when you see Black Friday sales, you know it's a discount, and you can't wait to go in there and buy multiple things. When you see a store is going out of business, doors closing, sale 70, 40% off, 80% off, you in there because you know it's a sale. Think about stocks the same way. If a stock drops 10%, that's a 10% sale. Drop 30%, that's a 10% sale, as long as you feel that that particular investment has some longevity. I got to keep reiterating that. So stock market correction is when the value of an asset declines by 10% or more when compared to their most recent peak. So it may have been sitting at $100. I'm going to use that example again, but it dropped to 90. So it dropped 10%. That's considered to be a market correction because it may have been overinflated. It may have not should have been worth that amount anyway. So now it's an opportunity for you to buy more. And then it may drop some more. And it's different terminology based on the percentage, but this is just an example. Market correction is an opportunity to average down in many cases. Next up is a stock market crash. And this is important for you to understand the terminology because they say a stock market crash is among us based on certain statistics and yield curves. And I'm not getting into all of that because, of course, I'm not a financial advisor, and some of this stuff and terminology, I wouldn't be able to break it down in a way that an elementary student can understand it, but I will talk about the things that I do understand, so that's what I want to give you. But a stock market crash is a sudden dramatic decline of stock prices across a significant cross-section of a stock market, resulting in a significant loss of paper wealth. That's very important to note, paper wealth. Crashes are driven by panic as much as by underlying economic factors. They often follow speculative stock market bubbles. So, what that basically means is it's a dramatic decline in the stock prices. So it's a loss of paper wealth, and I get into another slide of what that means. But it's usually driven by panic because when people see the stocks dropping, they panic and they get rid of them, and it further deepens the crash. And then sometimes there's other factors as well that follow speculative stock market bubbles, meaning that it may end up following when everything was so inflated that it was just a matter of time before that bubble popped. It popped, and then that stock had to drop. So a stock market crash is also an opportunity to average down and buy more if it's a company or an investment that you firmly believe in. Now, panic selling is what I was just mentioning. A lot of times, if people see a stock going down, they sell out of panic, out of fear of losing. So they panic sell like, no, I got to get rid of it. But you never want to sell at a loss. And I'll talk about that next. You never want to sell at a loss. And if you panic sell just because you're like, it's going down, to never recover, you got to have a strategy behind it. If you sell at a loss, it got to be a strategy. You may want to sell because you know it's going down some more. And you sell it at that number that it is. So say it was at 100 and it crashed and went down to $50. I'm going to just say that. So you lost 50% of your money. Or now, say it was going down to 50, but you saw it at 70. At $70. So you lost 30% of your money. Say you sold at the 70, and now you took a loss, but as soon as it went down to $50, you rebought more while it was at $50. So yeah, you lost 30%, but you was able to reinvest that 70% amount that you sold at and buy it at 50% to make up 20% of the 30% that you lost. I hope that makes sense. So you lost 30%, but you sold it, and then you say, you know what? I'm going to wait on it to go down a little bit more so I can buy it at a lower cost, and now you made a portion of your money back. So you got to know what you're doing if you do that. But most people just panic sell instead of just keeping their money in there and just buying more if you got the capital to reinvest and buy more. So I know you've probably seen this meme floating around and people always edit it, but this one says everyone panic selling in the stock market crash due to Corona. So last year, some people was doing some panic selling due to Corona and things of that nature. But me, or somebody who's an investor, they say a new investor in here, they look at it like, I'm ready to buy some cheap stocks. So some people look at it as a crash, some people look at it as a sell. You got to choose which side you want to be on. Now, when I was talking about losing, you never lose unless you sell. And if you panic sell, sometimes you take a paper loss. So if you just sell, you take a paper loss. But when you panic sell, you turn that paper loss into a real loss because it's just a loss on paper. It might not look good. I got some things that's down in my portfolio now, and I'm like, I don't look good, but I believe in the company due to certain things. I'm like, let me buy a little more. Let me buy a little more because when it goes up, it'll probably be worth double what it is now. So you got to understand, if you sell, you turn a paper loss into a real loss. So a paper loss is when your investment account has fallen in value, but you haven't actually lost any money because you haven't sold anything. It just looks like it's in the red, but you ain't sold nothing. You still own the same amount of shares. The shares are just worth less. So it's on paper as a loss. However, panicking and selling when your account has fallen is one sure way to turn paper losses into real losses. Because if you sell it, then you're guaranteed to have taken that L. But if you keep the same amount of shares that you had, then you never really lost. And now you give that same portfolio the ability to climb. And if you invest more money, then you benefit from the growth of it, because it does take a time to bounce back from losing money. But if you invest more into it, now you can at least turn your new money into some strong gains. So that way you don't take your paper loss and turn it into a real loss. Hopefully that was clear. Now, the reason why I said if you reinvest instead of panic selling is because you want to have some additional capital, also known as what they call dry powder. And I'm not going to read all this. I'm just going to read the main part. But dry powder is just extra money that you got that you can put into the market. So you're prepping, you're expecting some stocks to go down or the market to go down, but you got some extra money to where, okay, yeah, the market went down, but I had an extra $1,000 that I went ahead and put into the market and bought everything while it was on sale. Some people have really become multimillionaires or billionaires during that time because they caught everything on sale. They had dry powder on deck. So dry powder in the financial world refers to a couple of things: financial reserves and liquidity, basically having cash on hand. Therefore, the term is often used in the area of personal finance, corporate environment, and venture capital or private equity as well. Dry powder is that amount which can be easily converted into cash whenever required. Another form of dry powder is if you're buying into something that typically doesn't move. Just as an example, AT&T stock is known to be a good dividend stock. People like to own a lot of it because they want to receive the dividends that they pay out. But it doesn't move much. It usually stays around $30. $30 here, $29 there, $31 here. It really doesn't move. But people keep their money in there as a form of protection. It's like, okay, let me at least own some stocks. They're going to pay me out every now and then. But people also decide, okay, I got a couple thousand in AT&T. I know it's not going to move much, so I can go take some of this money and put it somewhere that has potential to grow faster. And then when I take some profits from that investment, I can put it back into AT&T, but I turned the $1,000 I took from AT&T into $1,500 or $2,000. So, you know, you just got to understand how it works. So dry powder can be extra capital that you just have that's not being put to work, or you may be able to pull it from a stock that is not known to go up much in value, just as an example. And I won't read the rest, but you get the point. And the last thing I want to talk about is say no to FOMO. A lot of times when you hear about a lot of people talking about stocks, you got to invest in this, you got to invest in Tesla. Don't get me wrong, Tesla made a lot of money. I missed that boat too. I mean, I had an ETF that had some Tesla in it, but I missed the ride of Tesla. Even though I like the idea of electric cars, I still miss that ride. But FOMO means fear of missing out. So if you hear a lot of people talking about it, just like they did GameStop, they were yelling about GameStop this, GameStop that, and some people started investing in it because they had the fear of missing out. They let me put anything in it because I don't want to miss out. Same with Bitcoin. That has happened to a ton of people. Fear of missing out. I don't want to miss out. Now, granted, some people who kept theirs and didn't have the panic sale, they're benefiting from the fact that they did invest a decent amount into certain stocks such as Tesla or even Bitcoin, you know. But avoid fear of missing out. Don't make a emotional decision to invest your money if you don't know what you're doing. Instead, pay attention, calm down, see what stocks you can buy that's on sale, because even though it might be some stocks running up, it's always some underpriced stocks in the market that should be worth more, but now you can get them at a discount just because nobody's talking about them yet. But when they do start talking about them, you'll be already in position. So avoid fear of missing out. Think like a long-term investor. Hopefully these terminologies have been a benefit to you. Let me know which one stood out to you the most. If anyone gave you a light bulb moment, which one do you like the most? Which one do you feel can make you the most money? I like averaging down. I like the idea of averaging down, plus amongst some other ones as well. Otherwise, I wouldn't have shared it. But let me know which one you like the most and why. Let me know if you've already been applying some of these. Let me know if you will apply any of these. But that concludes this training for royalty members and those who are just tuning in from afar. But consider joining the economic empowerment movement known as the royalty movement. Why? Because you see, we live in a world where we are conditioned for failure. And oftentimes we have been programmed or fooled into mediocrity. So people find themselves living like peasants instead of the royalty that they were meant to be. But you see, here in the royalty movement, we see the king in you. We see the queen in you from start to finish. It is time to take your seat on the throne. because this is what we uplift your character, your confidence, and your cash flow. As royalty, you should establish a solid financial foundation that will soon lead to your abundance and thriving empire. Take your seat on the throne. You are royalty. Salute.